It's been a brutal start to the year for stock market investors, but turns out some investors really managed to pull through with cash-generating companies, much like Oracle Corp. And while the first half of 2022 was full of surprises, what's next for developers, tech workers, and startup founders? Let's take a look at the bad news piling up over the past few months and why tech stocks suck right now in 2022. First off, what's really going on? It's been one heck of a ride. Back in 2020, technology stocks were shooting high with companies like Amazon and Netflix, which had the upper hand because of the pandemic and lockdowns. Driven by stimulus money and insanely high demand, they were the ones to beat. With that said, 2022 hasn't been very loyal to the tech sector. So here's what happened, or at least the major bad news. The tech-heavy Nasdaq Composite is down around 23% for 2022 after soaring 21% last year. And just for the sake of comparison, you need to take a look at the S&P 500, which is an index made up of 500 of the largest US companies from different sectors. Well, to say the least, the S&P 500 fell by 13% this year, and even after the overall stocks finally bounced back last week, some of our favorite technology giants are still not doing so great, with Meta down by 42% and Netflix down by 67% this year. And remember the sudden increase in demand for Zoom during the pandemic? Well, the popular at-home tech company is also down by 40% this year. And that's not all. Even the shares of Google and Apple's parent company, Alphabet, have fallen over 20% in 2022. And that's just until last month. We're still not sure how bad this is going to get in the next half of 2022. Investors are definitely looking at technology stocks after the remarkable turn of events. And dominant companies on the planet are still suffering a loss of 40% or so in the span of just a few months. And just take a look at the stats for your favorite companies. Microsoft's down by 27%, Apple's down by 17%, and even the semiconductor heavyweight Nvidia is down by 44%. And that's not all. The communications sector also faced a disaster of its own. Check out the stats for typical household names. Facebook down by 44%, Netflix down at a surprising 73%, and Google down by 22%. Now, how did the tech stocks rise in the first place? And discounting future cash flows back to the present value, the higher discount rate is bound to result in lower valuations. So when experts say that the math has changed when calculating a company's valuation, they're not wrong, and investors need to understand the dwindling demand of the technology market. When Americans were stuck at home for days on end, there was an increasing demand for many household products and services. The lockdown had people turning to online shopping, and no one could have had a better business than Amazon at the time. So it's safe to say that online shopping helped pump up the stock prices of the companies providing these goods and services. However, it was a pandemic-driven bubble that was expected to burst. The world looks a lot different than it did in 2020. People are dining out, traveling, and working in offices again, basically reliving the life they did before 2020. Peloton, for example, the at-home workout company, witnessed tons of success during the lockdown, only to lose $757 million in the first 3 months of 2022. Up next, how did some investors survive the disaster? Investors need to know where to invest. Yes, we're hinting at the bigger cash-generating, dividend-paying companies that somehow pulled their investors through the chaos. And their performance throughout is a testament to their resiliency with strong profitability, enough to reward their investors with payouts. And chief investment strategist Mark Lucchini seems to agree, as he was quoted saying that the companies that have the cash to generate a sustained payout for their investors, regardless of the unpredictable economic conditions, should definitely continue to work in the near future. Let's talk about these companies. The renewed focus on stocks like Cisco, Oracle, and even IBM, whose dividend yield currently sits at 5%, is after the years of fixation on other organizations like Netflix and their increasing demand resulting in rapidly expanding revenues. Having said that, what's important for investors is focusing on companies with strong profits that can be reliable for investments during the economic uncertainties. Let's talk about the math for tech stocks that isn't really the same anymore. When experts are trying to determine a stock's value, they look beyond the cost of each share. Another factor that influences their decision is the price-to-earning ratio, which is typically the price a stock is trading versus the actual profits of the company. And when we're talking about tech stocks, well, they are high-growth stocks with a fairly high price-to-earning ratio. With that said, the general expectation for a majority of these tech stocks is that buying them will potentially pay off in the future. Why? Because of their high growth potential. But what investors didn't expect was how the interest rates would rise, and that would in turn constrain businesses and consumers' abilities to borrow and spend. But what should investors do now? The market gives investors a real-world experience, from stock investing to valuations. And when there's an economic crisis, it only gets worse. And yes, the numbers around the tech stock losses have been eye-popping, but some say there are enough good reasons for their fall. Honestly, the declines have been pretty dramatic, with scary headlines making the news every day. So it's important that investors start looking at the market returns long-term. Sadly, experts believe that 2022 may end up as being a terrible year for investors, despite the good fortune we saw in the last 3 years. Plus, investors need to take a step back and rethink their financial plans now, because they can use pullbacks as opportunities to take advantage of dislocations in the market. It's a better time than ever because right now, the stats show that technology stocks are literally the cheapest they've been since March of 2009. And that's when markets were just starting to recover from the global financial crisis. So see that? Think about it strategically, and that's a window of opportunity. Moving on, we're aiming for big gains after big losses. This video video isn't just about everything that sucks about the tech stock right now. We're also going to let you in on the key strategies that experts believe will help investors get back on track. Without a doubt, we've seen some huge declines in the market right now, but what would you think if we said it's still a good time to invest? Well, when stock prices are struggling, it's time to focus on profitability. Some companies like Microsoft and Apple, despite their decreasing valuations, have still managed to remain profitable overall. But if you take a look at some other small and mid-cap stocks, you'll find a lot of companies that aren't profitable anymore. So when you buy a stock just because it's low, things can get pretty dicey. The risk is that you might be investing right before the company's valuation and profits decrease even further. So cheaper stocks aren't always the answer. And if you buy a stock and it falls 10%, you're going to need an 11% gain just to break even. And this is pretty risky because there's absolutely no guarantee that any individual stock will get back to its 2021 high. So what do experts say? Well, for one, don't spend all your money in one day, even if you're sure about where you want to invest. Instead, try a dollar cost averaging method, which is basically investing a modest amount of money at regular intervals instead of just pouring your money in all at once. So if you got $10,000, you're going to invest $1,000 every other Friday. Basically, that's a disciplined approach to minimize risk and buy you some time to see what the stock market looks like. And while technology is still the future of the American economy, experts believe it's going to take a while to recover from this economic crisis. So what does the future look like for tech stocks? Well, for starters, a lot of their current performance is simply the result of unwinding their excess performance. Many of the companies facing a loss today were considered defensive, durable business models 2 years ago, and that led to crowded investments, because everyone wants to invest in the most valued company out there. With that said, the herd mentality pushed many mega-cap stocks to record pretty hefty valuations. But soon after the lockdowns ended, other factors came into play. But bigger companies like Meta and Google still survived the economic crisis. How? Because they're characterized by their ample free cash flow generation, strong balance sheets, high profit margins, and returns on invested capital. Each one of them is a sign of a high-quality business. To wrap it up, experts say that each company, big or small, seems to be getting punished, with smaller companies completely out of the picture. Having said that, the stronger companies are getting punished because of their huge valuations that were just not maintainable. So in the long term, experts still see a huge opportunity for investors in these strong companies that will survive the economic crisis and continue to grow once the market recovers. That's a wrap for this video. What's your take on the tech stock situation right now? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you in the next one.